Hey, good morning, everyone. Marty Mazzori here. Wednesday, the 26th of October, 2022, with your midweek market snapshot. Just going to play around for a few minutes with the S&P 500 charts, starting with the daily. As I pointed out the other day, this 20-day moving average. Now, I've zeroed in on the 6-month chart here so we can really see what's going on. But if you recall, when we take this yellow line back, it has been, for the last year or so, a pretty good area of support and resistance. And when we've broken above or below that, it's tended to be meaningful ultimately. When we go back to August and we hit that top there that we had circled on the way up and rolled over, it accelerated, as you can see here, as we broke down below the 20-day. And then that had served as pretty strong resistance all along up until we bottomed right at our price target from months ago at 3,500. Bounced off of that with a massive engulfing candle, where the green candle here, the body of it, engulfed the 3 prior days. That's kind of unusual. Then tested that big red candle the next day, came off of that, and a few days later had another big engulfing candle where 3 days were engulfed. And I said these are unambiguously bullish patterns, and as well broke above this falling wedge pattern right here and above the 20-day moving average, which is now sloping higher. Then continue to accelerate through these resistance lines that I had drawn here, had to do with gaps and other things, and now testing the 50-day moving average. Now we get a break above that, and this becomes something even more compelling from a technical perspective. Another thing I want to look at too is where we sit in terms of retracing this decline that we've had off of this top here. So what we do is we take we look at the Fibonacci grid, and so we go to the top, take us down to the bottom. 50% retracements are huge, so are the 38.2 and the 61.8. And as you can see, we've got this resistance on the 50-day. And by the way, this is a delayed chart, and as I speak, the S&P is actually positive by about 0.25% at 38.68, which is above the 50-day moving average. So we're kind of breaking above that, as you can see right here. I would expect to run into some headwinds around 3,900, which happens to coincide right at that 50% retracement. Make no mistake, that's an important technical level. Technicians are going to be trading that here, so it wouldn't surprise me to see a pause. You get a strong break above that, and you could continue to see momentum to the upside. And of course, operative word is always could. So folks who read the blog, you saw that yesterday, I continue to paint this picture that this looks very technically positive to me, seasonally as well. But I did say that we have earnings coming out, and that if an Apple or likes of an Apple or two miss, that's something that could have traders turn tail. Well, Google or Alphabet missed big yesterday, as Texas Instruments missed, and overnight we had the NASDAQ 100 down like 2.5%, and the S&P down a bunch, but the S&P equal weight index, as we opened this morning, was like 1% better than the rest of the market. Our core portfolio was quite a bit better because we have a lot of commodities and value type and international exposure there as well. Then the S&P 500, which is heavily in technology. Of course, the NASDAQ was taking such a big hit. But even now, as I speak, as I mentioned, the S&P is kind of flirting with positive territory, and the NASDAQ 100 is only down 73 basis points. That's a far cry from where we were. So amid these kind of miserable earnings and not real rosy outlooks, what gives? Well, again, the technicals are positive right here. We came into the quarter with really ugly sentiment. Our fear index was trading really high in terms of high fear, and that's contrarianly, that's a bullish sign. And we have, in my view, although a lot of people disagree, but in our view, I should say, a Fed that's really getting nervous. And we talked about why. The happenings in the United Kingdom, lack of liquidity in the Treasury market, the Treasury actually flirting with the idea of issuing very short-term debt to buy back long-term debt out of the marketplace. These are actually pretty bullish for asset prices, which tells us that the Fed fears something cracking out there. So what we would call potentially systemic risk out there, that pushing the needle too fast on interest rates and sucking too much liquidity too quickly out of the economy could blow up in their face. So I think they're become concerned about that, moving too far too fast. They're now paying lip service to the lag effect of Fed policy, meaning when you raise interest rates, it doesn't ripple through the economy supposedly for months into the future, and the market is sniffing out those hints and doing it as a positive. But again, I must say, though, we came into this, which is the best season of the year, with terrible sentiment and a growingly constructive short-term technical setup. So it should be no surprise to anybody that we're seeing some strength right here. Whether or not it lasts, of course, remains to be seen. We've got midterm elections, we've got the Christmas season to get through, and we do have what we think is a longer-term setup that still says that our 3,500 original price target for the bear market may not hold. And the reason it may not hold is because when we set that, our recession indicators were not flashing red. We were still in an environment that suggested odds favored continued expansion. That's not the case anymore. Odds favor recession in the near term going forward. Although our assessment of that recession is that it will be a mild one by historical comparisons. If it's a mild one, maybe this 3,500 holds. If the consumer holds up well enough, if things like China, abandons or begins to abandon its zero COVID policy. I understand everything that went on over the last week with the 20th National Congress and how weird that was, and the things that were said. We saw a big exodus foreign money out of China as that conference came to a close. At the end of the day, folks, the notion that Xi is ready to go at Taiwan, militarily, and just utterly destroy the Chinese economy and do huge global damage amid the other side of his ambitions in terms of global outreach and all these other things, just doesn't make a lot of sense to us. The consolidation of power, the control and so forth, the rotten demographics in China, all of that long term is very, very important. In the near term, I think while this leadership may not prioritize the economy as much as previous leaderships have, make no mistake, they do have their own constituents to deal with, and the last thing in the world they want to do is depress them into a North Korea sort of setup. So long term, we have some concerns. We are very bullish in some emerging markets going forward, and so we may very well in the years to come have less exposure to the likes of China and much greater exposure to the likes of the Latin American countries and so forth. We think Mexico, for example, is a chief beneficiary of kind of that deglobalization that's pulling the world away from that manufacturing hub that has been China for so many years. So anyway, a lot of that is to come. That's that long-term view. We are very, very constructive on how we're investing with a 5-year time horizon. The next few months are going to be precarious, and we do think that maybe it's in the first quarter that this bear market works its way a little bit lower. Could be a lot lower if something breaks or if the recession's worse than we think. It's going to be important to continue to hedge that big tail exposure the way we do it with out-of-the-money S&P options, that sort of thing. I think that's going to be important because that risk is still there. But as clients, as you've known from recent discussions, we are becoming concerned now with being in the right place as we ultimately work our way out of this, in the months to come. And then there's a whole other narrative as we get deeper into 2023, and has to do with a lot of things, a lot of infrastructure, investing globally, what that's going to do with inflation and central banks. So there's lots and lots to work through and to manage through, in the months and years to come, of course. Okay, so again, there's your daily chart. Making some hay this morning. Expect volatility. If we do continue to move higher in the fourth quarter, it's not going to come on an everyday basis like the last few days, of course. There's going to be choppiness. There's going to be ups and downs like we've had in here. That's just the nature of markets. And then really the most bullish chart, longer term right here, is the weekly chart. We have a definite falling wedge pattern. That's there. Few would argue with that. And we have these positive divergences, and we're about to get a buy signal if this keeps up on the MACD and break through the downtrend line here. So those would be very, very bullish. And it's when you break through is when it becomes meaningful, and this divergence becomes meaningful once that white line breaks above the red line. Let me go back to that daily chart because I didn't show you the MACD and the RSI there. Really bullish look down here. We had our higher lows here and our lower lows here, and we were pointing that out. Sure enough, we came off of that, right off of our bottom target here with some strength, and it was all foretold technically in the shape of the move and then the positive divergences. And it looks like we're just gaining steam, and we're not even above the zero line here on the MACD. That move above that is bullish as well. So again, it's you can sense the optimism in my voice, but it is guarded optimism. Make no mistake. It wouldn't take much to get people to run to the hills again right here, even during this, this great seasonality that I keep talking about. And then to wrap up, we'll take a look at the 60-day, 60-minute chart. And it, frankly, is the least constructive. It's not horrible, but again, it did show here coming into last night, our uptrend losing some steam in here. You could do that, and you have your rising wedge, right? You had a flattening out MACD, and you had a beginnings of a rolling over RSI, so lower high, higher high, negative or bearish divergence. Had that gap down this morning, although we're coming back up right here and testing these levels. So what do we look like here? Right, so you go right through there, and we're right at a zone that we, had that was support back in early September, and then came back and tested it and then failed, and then it was resistance. Old saying, what was once support becomes resistance and vice versa. So makes sense, right? Right here, we're struggling against that. On the other charts, looks like we may very well break above that, and then that'll be support. So, jury's out on the hourly chart. Technically speaking, pretty positive setup on the daily and the weekly, and lots can get in the way. Let me finish with reminding you that we are in a bear market. And of course, it is in these bear markets where these bullish patterns are most apt to failure. So, so anybody who's watching this, if you're trading the market short term, be on your toes. For our purposes, on behalf of our clients, we're long-term investors, and we like what we see on a very long-term perspective, at least based on our view of the world and where the opportunities lie. Short-term, again, reason to be optimistic, but I'll say it one more time, stay on your toes. Folks, thank you as always for watching and listening, and I'll talk to you again very soon. Bye-bye.